This is Jason Kelly with the Kelly Letter. In this video, I'll answer questions recently emailed to me by subscribers regarding Russia's invasion of Ukraine, its impact on the stock market, and how that's affecting our plans. I won't have time to get to all questions today, but I can always do another video later. To start with, Gianmarco in Munich, who subscribed in 2010, asks, my Ukrainian girlfriend Oksana wants to know, if there was a third world war, what would happen to the stock market? Could it crash to zero? Would it still make sense to invest in such a time? Stocks have actually done well through past wars and all manner of geopolitical conflict. I've written about this quite a few times, both in my books and in the Kelly Letter, so this will be familiar to many of you. But just to come up to speed with the recent events, because everybody always thinks this time is different, LPL Research looked at 22 major non-financial shocks since Pearl Harbor in 1941. And Bloomberg ran a table of the results of that. And I've got that table from that article. And the table looks at the event that impacted the stock market, how far the S&P 500 fell, and days to recovery. So let's look over that list together here on the video. The one that was longest to go was the attack on Pearl Harbor in 1941. And that was also the one that exerted the biggest impact on the stock market, which in this table is defined as the S&P 500. So stocks means the S&P 500. After the Pearl Harbor attack, the stock market went down 19.8%, and it took 307 days to recover. Now that is shocking to me on the mild side, and not to diminish the importance of Pearl Harbor, quite the opposite. Something as big as that, World War II, and stocks still managed to recover in less than a year, that's incredible. And that's the top end of the scale, which shows you how minimal geopolitical events have been for stocks. Coming down the list, the most recent big one, which is not that big, but Iraq invading Kuwait in 1990 sent stocks down 16.9%, and they recovered within 189 days. Then the next one that's fairly recent is in 2019. That's the Saudi Aramco drone strike. Do you even remember that? I mean, that's not something that comes to people's mind as a major geopolitical event, but that ranks on this list. The Saudi Aramco drone strike of 2019 sent stocks down 4%, and they recovered in 41 days. And we come down the North Korea missile crisis of 2017, I've lost count of how many North Korean missile crises I've seen, especially living here in Japan. They seem to happen every other week. They've even been going on during this invasion of Ukraine. Even during this invasion of Ukraine, North Korea has been firing off missiles. You just haven't seen it because nobody's paying attention right now. But North Korea is upset about not getting any attention recently, so they're sending missiles right now, and stocks couldn't care less, and they didn't even care less in 2017 when it was actually called a crisis, since nothing else was going on in the news at that time. Stocks went down 1.5% and recovered within 36 days. You're starting to get the pattern here. The Boston Marathon bombing of 2013, stocks went down 3%. 2 weeks later, they'd fully recovered. In 2020, remember when the Iranian general was killed in an airstrike? That took stocks down less than 1%, and they recovered in less than a week, only 5 sessions. This is par for the course with geopolitical events. They just don't affect the measurements that stocks care about. They don't impact earnings directly. They don't affect economies that are not involved in the war. And even the economies that are involved in the war are sometimes helped by the war, which seems wrong to talk about, but that's just how it goes. Trade still happens. Things that are needed in the war go up in price. Companies make those things. It's a complex interaction of factors, and it doesn't automatically mean when there's a war, you run away from stocks. In fact, quite the opposite. Warren Buffett recently talked about this, that stocks generally go up during long wars, and other assets such as cash in a bank end up going down. Just ask Russians who had rubles in the bank. Now, what Oksana was asking, Gianmarco, who's my subscriber, Oksana, his girlfriend from Ukraine, was asking, but if this becomes a big enough war, such as World War III with nuclear weapons, to send stocks truly to zero, would that be a good time to invest? Well, the more salient point is, would we care about stocks at that point? And I'm not making a joke about it here. If something's big enough that stock markets are going to be eliminated, we've got a lot more to worry about than the value of our portfolios. The examples I've used in my books are a meteor struck, or, I mean, who knows, right? But just if it's the end of the world scenario, then it's bearish for stocks, but it's bearish for a lot more than that. And I recently saw one of the strangest research notes I've ever seen. It was a March 4th note from BCA Research. let me pull this up to make sure I get this right. The headline of this was "Rising Risk of a Nuclear Apocalypse." Okay. In its executive summary, it says that Putin has committed himself to orchestrating regime change in Kiev. Therefore, anything less will be seen as a defeat for him. If he succeeds, not a foregone conclusion anymore, the perpetual insurgency will deplete Russia's resources. One way or another, Putin is going down, and you can be sure he'll take as many with him as he can. Therefore, quote, if Putin concludes that he has no future, the risk is that he will decide that no one else should have a future either, end quote. The firm assigns, quote, an uncomfortably high 10% chance of a civilization-ending global nuclear war over the next 12 months, end quote. Now, at this point, would you not assume that this is a bearish forecast? I did, but no. Quote, despite the risk of nuclear war, it makes sense to stay constructive on stocks over the next 12 months. If an ICBM is heading your way, your portfolio becomes irrelevant. Bottom line, the risk of Armageddon has risen dramatically. Stay bullish on stocks over a 12-month horizon, end quote. Now, this is not funny, but it reads like an Onion article. It sounds preposterous, but the logic of it is sound. If it's not going to be the end of the world, if it's not going to have a big impact, then stocks are probably going to be relieved and do just fine. And if it is going to be the end of the world, then you won't care about the value of your portfolio. Nonetheless, some investors had fun with this. I read different analysts writing that ICBMs are bullish because they might push the Fed funds rate negative. And my favorite is an old New Yorker cartoon by Bob Mankoff, which shows a man in a suit speaking from a lectern with a bunch of guys, presumably on a board of directors behind him. And the caption under it reads, quote, and so while the end of the world scenario will be rife with unimaginable horrors, we believe that the pre-end period will be filled with unprecedented opportunities for profit, end quote. This is not meant to make light of this, but just to point out that stocks have done well through wars. They will probably do well through this war. It doesn't involve much of the world directly at this point, but Oksana was asking about a world war. So if it got to that level, either stocks to be relieved at the lack of damage and you would want to own stocks through that, or everything would be wiped out and it won't matter what your stock portfolio did. So I would like to also add that I personally believe this is highly unlikely. I expect the world to continue. I expect to keep sending Kelly letters every Sunday. So don't take away from this that Jason thinks the world will end, but we'll own stocks right up until that moment. I don't think the world's going to end from this. Wartime price discounts, like all discounts, should be bought. That's what our systems do. We are indifferent to what's pushing prices down. If it's a war, if it's a pandemic, if it's a reaction to one or the other, whatever it is, we buy lower prices and we sell higher prices, and we don't care what's pushing those prices for the portfolios. We're not insensitive to what's happening in the world. Just the portfolios do not care why prices are moving where they are, just that they did. So that's why we would keep running our portfolio the same way. And I would encourage anybody who's a stock market investor to keep investing through whatever this war turns into. Now, turning to other questions, several people asked, is this crash different from 2000, 2008, and 2020? Well, they're all different in narrative, right? The least believable for me was 2020 because it was a deliberate shutdown. No economic hurdles whatsoever. We had a perfectly fine economy. The pandemic came, they shut down the economy, and then they supported it. So, and that's not just hindsight saying that. You will remember from March 2020, I thought so at the time. It looked like that all the way through. It still looks like that going back, and the world will just never apparently come to the conclusion that we never really had any direct damage. We just acted as though we did. And I don't want to get into that, but the point is that was the least believable crash to me in this century so far. Then we go back to 2000, which was a bubble pop as tech rose on no fundamentals. And that was the era of pets.com and just completely ridiculous business ideas that were were given temporary credence because they had a dot-com at the end. That's why it was called the dot-com crash. So we had companies with no fundamentals going up in price simply because they were connected to this new thing called the internet. And that was restricted mostly to the tech sector, and which was really bad. You wouldn't want to be in a single sector that does get overvalued like that. And I'll come back to that later because I know many of you are wondering, what about our 9-sig plan? I'm aware of that question. 2008, in my view, was the worst financial crisis of my lifetime of investing because it looked like the pillars of the very financial system were collapsing. They had placed these toxic assets all over the financial system and they were all blowing up. It looked like the entire edifice was going to just crumble. It didn't. I mean, ultimately, if we could get through that, if they could patch and glue and tape that thing back together and we could keep going after that, that should give confidence, in my view, that we can get through anything. I've written about this before, that it's never game over for the stock market because the whole thing is human made. It's human concocted, human run, human ruin, human repaired, and we're never going to not need it unless we get that global wipeout that Oksana was talking about, in which case it won't matter. So how is this different? It's different because my interpretation is this, and keep in mind that I'm not a big believer in narratives. I don't really know that anybody knows why stocks are going down, but let's just say for the sake of argument, they're going down because highly supportive monetary policy is coming to an end. We have a high rate of inflation, and on top of those worries, we got this invasion of Ukraine, which I believe surprised a lot of people. It surprised me. You'll recall that I did not expect Russia to invade. So because of these factors coming together, and then the invasion of Ukraine sending the price of oil up, contributing to inflation, which is going to make it harder for the Fed. So the idea being that the Fed needs to raise interest rates in order to keep inflation down. But if it does so too quickly, it'll send the economy into recession and the punch bowl is being taken away from the stock market. That is the narrative happening right now. I don't see that as being a very big deal, which is probably sacrilegious to say in this moment, but I just don't see the big threat. Geopolitics are not a big threat, as we just covered. Stock market earnings are fine. They're strong. Now we have lower prices than we had before, kind of deflating the bubble argument in a turnabout of words there. And I don't see that monetary policy is going back to something awful. It never was burdensome in recent times. And the Fed wants to get back to a more normal monetary policy, but not a restrictive one. So we're not going to go to 15% interest rates, for example, just to be nuts. We're not going to go that far. We're going to get a more normal, but still supportive monetary policy, which indicates the strength of the economy. I'm not really worried about inflation. Oil is going to come back down in price. The world's not dependent on Russian oil. It's already gone up way too much. It's a speculative reaction that would come back down. Countries are pulling out emergency reserves of oil. We have plenty of spare capacity of oil. Shale can crank back up. There's just no question oil will come back down to a more normal operating range. Supply bottlenecks, which have been contributing to other types of inflation, are also temporary, and we should acknowledge not as temporary as the Fed was saying a year ago, and frankly, not as temporary as I thought they would be. So they're longer lasting than a lot of people thought, but I still think they're going to go away, and quite a few analytical firms think so too. And I don't mean people on TV making zero validity forecasts. I mean analysts of industry who are looking at shipping rates and cargo data and so on, saying that it looks like we're finally making progress through this bottleneck. So that's how this crash is different from the other ones we've seen this century. I think it's less dangerous to anything we own because there's no fundamental disconnect from company performance and stock prices as we had in the dot-com crash. There's no financial systemic threat like we saw in the subprime mortgage crash. And I would say this is a little more serious than the COVID crash, just because that was based on nothing except an artificial shutdown, whereas this does have some genuine factors that stocks care about, but nothing they haven't dealt with before and nothing they won't get through this time. All right. A guy from Geneva who subscribed in 2013 asks, after the COVID crash, we had a V-shaped recovery. With this conflict, how much risk do we have of an L-shaped one? And several people have asked a variation of, the recovery this time will not be as strong as the one in 2020. How will a slow recovery affect our plans? How do you know? I mean, that's the first thing to say, right? Let's not get goofy in hindsight here and pretend that March 2020 wasn't a complete panic attack. Come on, you're being dishonest with yourself and you're not doing some basic Google searches on what media were saying at that time. At that time, they were not saying, oh, this will be an easy recovery. This is a breeze. Everybody should buy stocks here. No, it was the end of the world, which should sound familiar. So let's just put that out there, okay? That nobody knew it was going to be a V-shaped recovery. We didn't know either. We just followed our plans. Hint, hint, keep following the plans. Prices were way down. We bought them way down. They came back sharply. Yes, it's true. The Fed came in with monetary support for the artificial shutdown. But guess what? At the time, pundits were saying the Fed's out of ammunition. It's never going to work. They've never faced anything this big. Interest rates are already low. They're out of bullets, right? Any of this ringing a bell? So let's not pretend that everything was just roses and looking fine in March 2020, but this time we've got a real problem. No. We've got a geopolitical crisis, which is going to pass one way or another and probably won't affect stocks. Remember, even World War II didn't keep the stock market down. We are going back to a normal monetary policy. The Fed's not going to just suddenly crash the market. Things could go wrong. I'm not saying they can't, but I don't think there's any reason to think we're going to have an L-shaped recovery. Earnings are fantastic. The economy is looking great. There are plenty of jobs out there. Look at the unemployment rate. Look at the amount of cash in people's banks. I mean, all that stimulation that happened over the last 2 years on top of an economy that was just paused is there and ready to rock. And that's partly why we're seeing inflation. The people have plenty of money. They want to buy things and there are supply bottlenecks. So I just want to disabuse you of this idea that we knew in March 2020 stocks were going to rocket back. And this time we know they won't. We didn't know then they would. We don't know now that they won't. So what if you just ask yourself the opposite? In March 2020, the narrative was stocks can't come back, Fed's out of bullets and so on. And it turned out that none of that was true. What if the narrative that's prevailing now turns out to not be true? Just go through that thought experiment for yourself. What if the war winds down? Putin vacates the world stage one way or another, and Russia becomes a better global participant. Looking over my notes here, what if supply chain issues get worked out? Price of oil normalizes without the reopening shock that was widely predicted because we've already been pre-shocked in a way. One thing analysts have been saying is that as the economy opens, we're not going to have enough oil and there's going to be an oil shock then. Well, oil shock, check, right? We've already done that. So maybe now we don't have to do that again, and it's already priced into the market. As for how slow recovery would affect us, our plans would ride it out. Well, what do you think I'm going to say? A slow recovery would have us bailing out? Of course not. We'll respond wherever prices go, whether it's a short timeline or a long timeline. There's no change in what we do. There's never a change in what we do. Commit that one to memory. Never. We're going to ride this thing all the way and we're going to be fine because of it. I mean that. Steve in Texas, who subscribed in 2009, asks, the higher cost of fuel and food are impacting my residential construction business because nervous buyers are slow to commit. When will war-related price increases abate? Analysts say to dig in for the long haul, but when pressed, they usually end up defining the long haul as weeks or even months. I don't think that's a very long haul. It's easy for me to say since I'm not in the residential construction business, but Steve and anybody else affected by this, I'm sure you've been through things that have lasted longer than weeks or months before. So I'm not sure how much credence to place in this idea that we're in for a long haul of prices being elevated from this war. Let me read from a little research I did on this, preparing to answer Steve. The solution to high prices is high prices. That's a truism of how markets work. We're already seeing the oil price shock hit a ceiling. I'm not saying it's over. I don't know, but it backed off on Wednesday. We saw quite a dramatic reversal already, and the war is still going on. The U.S. just passed sanctions on Russian oil, so according to the way analysts read this as being bearish, we're still in the thick of all the bearishness, and yet we're seeing oil prices come back down already, indicating one source of inflationary pressure that might be letting up a little bit. CNBC on Wednesday, quote, Brent crude oil, the international benchmark, fell 13% or $16.80 to 111.10 for its biggest one-day drop since April 2020. Brent has just hit 139 on Monday, its highest since 2008, end quote. This is consistent with the worst predictions happening at the bottom. That's always how it goes. The worst news, the worst predictions happen at the very bottom, and then you get a recovery as bad news keeps coming anyway, and it works the opposite at the top. That usually the top tick happens when they're saying, we're up this much and we're going to keep going higher. And that would kind of be the case here, right? That Putin's having trouble. He's going to ramp things up. The U.S. is sanctioning oil. Bad, bad, bad. And then in the middle of all that, this price spike reverses when you think, well, how can it be? We're still in the middle of all this, because that's how it goes. Now, by the way, Steve and anybody else impacted by this, I am not saying that oil is the chief factor that's driving up prices in residential construction. There are many other inputs, as you would know better than I. But it does seem like that's one example of how price pressure might be abating. I would think possibly more important to residential housing would be mortgage rates. I just checked, the 30-year mortgage rate is back over 4%. It was up at 4.3, down to 4.1 now, but over 4%. So that's going to be a different type of headwind. I hope that's a bit of encouragement, though, because that's not really related to the war. So it's not a type of inflation that's coming from the war. It's just a result of monetary policy starting to normalize and rates needing and already starting to head back up. Tommy from New Orleans, who subscribed in 2007, asks, will 6.5 years be long enough to recoup recent losses and add profit before retirement? Well, it should be plenty of time. I mean, I got the same question 2 years ago and we recovered. Well, let's just look. Let's see. In March 2020, people said the market wouldn't recover for a decade. That was my favorite forecast. We're not going to come back for a decade. They were even saying things like, you just lost 10 years of savings. We heard this just 2 years ago. Okay, exactly 2 years ago. Instead, TQQQ, which we were told would send us all to the poorhouse, fully recovered in 4 months. 4 months. Okay, SPY in 5 months. Am I saying that's going to happen again? No, but look at the recovery times for geopolitical events we looked at earlier in this video, and look at these recovery times. You don't run into many 6.5-year recovery times. They are out there. I know that. No need to send me emergency emails with red headlines. I realize long recoveries are out there, but I don't think there's a whole lot of evidence to suggest this is one of them. And you don't either. So don't fall prey to a talking head saying you just lost 10 years of your life because of Putin's invasion. I don't think so. I think 6.5 years, Tommy, will be plenty of time to recover this. He asks next, should I pull money out and buy dividend stocks while I wait? No, this is a strategic decision best made in non-volatile times. This is no time to be changing horses like that. The move now is to stay put for the recovery. If you switch out of your stock funds down here where we are now and go to something that doesn't decline as much, you're actually moving into something that doesn't recover as much after you already missed the chance to miss the drop. That's always how it goes, by the way. Everybody's most interested in protective portfolios when they should be interested in aggressive portfolios. Remember the old Warren Buffett advice to become greedy when others are fearful, and fearful when others are greedy? Well, here it is, right? Everybody's fearful. So don't you get fearful and go to something that doesn't decline as much, because what you're actually doing is going to something that doesn't recover as much. You don't want that. If you do want less volatility in the future, fine, make a note of that. And when you recovered back to where you were or gone up even farther, then make the switch into something safer at that point, not right now. And safer, I have to put that in quotes because it's not a matter of safety. It's a matter of how much volatility you're comfortable with to achieve your goals. Over the long term, it is not safe to fail to meet the amount of money you're going to need to amass, the amount of money you're going to need for a comfortable retirement. That is not safe. So in that sense, putting all your money in the bank is one of the riskiest things you can do because you're guaranteeing you won't achieve your goals. That's why I always want to put safe in quotes, because there's nothing unsafe about high volatility if you're managing it correctly, which we are. And then finally, are we near the bottom? Well, I can't know, and you guys know that I don't like to speculate on this stuff. I make this very clear, but I'm also asked many times, we know we're not going to hold you to this, but still, could you just answer honestly for change? We want to know what you think. Okay, yes, I think we're probably pretty near a bottom. The reason I think that is that the 9 sig buy signal is huge. There's no rule that says it can't be huge again. It could keep declining. That is true. But in the back testing and in the simulated testing and in real life so far, it's just come back nicely from declines like this. So there's a bit of evidence. We also see that in sentiment. Sentiment is very low right now. Greed and fear has come down to the extremely fearful zone. The VIX is over 30 even after the recovery on Wednesday. There's a lot of bad news already priced in. People are feeling pretty awful, as evidenced by this question. And usually when people are feeling this bad and nothing is so terribly wrong in stocks, we get a recovery fairly soon thereafter. I don't know, and it doesn't matter to our plans, but personally, I think we're probably pretty close to a good time to be buying, which is nice because we have our signal coming up. Nitin from the San Francisco Bay Area, who subscribed in 2012, asks, the IMF recently indicated war in Ukraine will have a severe impact on the global economy. Can the current state or the future state of war or sanctions imposed cause a recession or severe economic slowdown? Specifically for the letters portfolio, what could be the implications? Yes, if the war causes a big enough global slowdown that in turn impacts the earnings of the stocks in the indices we use, then that would affect our portfolio. But attention everybody, that's already happened, right? It's not a matter of, is this going to affect prices? It already did. And so now the thing to do is ride it out. There's really no reaction. Yes, prices could go down more, but we already have a plan that reacts to wherever prices go. So it's unknowable, and luckily we don't need to know. How would we react? By buying. As long as we could buy, we would buy. If we depleted our buying power, we would hold. If everything's collapsed upon collapsing, and some of our plans were more flattened than others, it's possible, very unlikely, but it's possible that I might move money around between the plans to try to keep buying into the more compressed leveraged funds. But we've never had to do that. In the past, when we've maxed out our buying power, we've just stayed put for the recovery, which has always come. Bruce in Arizona, who subscribed in 2011, and John in Rancho Cucamonga, California, who subscribed in 2005, and many other people asked a variation of the following question. With market indices so low, why don't we buy now? You really have to ask that, guys? I will humor you, but you do know I've answered this many times, right? We don't buy now because we don't know where they're going to go next. I was asked this question the second week of January, the third week of January, the fourth week of January. I was asked this throughout February. Is it time to buy now? Is it time to buy now? Is it time to buy now? I don't know. I just don't know. And I can't know, and neither can you or anybody else, which is why we stick to the schedule. Part of our buying signal is that pace. Okay, it's not just the decline in price, because even when we get to a good zone for buying, we can't know for sure that's the place to do it, which is why we set these demarcations. 4 times a year we revisit and we buy to the level it's at there, and that or sell, right? We react to the level that prices are at. That's key, because if, for example, prices are lower now than they will be in a few weeks, let's say we still have a buy signal in a few weeks, but it's not as strong a buy signal as we have now. Well, guess what? We wouldn't buy as much. The buy signal is proportional to the size of the discount. In that sense, it should take more stress off of you to catch this exact moment. A, you can't know if this is an exact moment, but B, even if it is and you miss it by waiting until the signal in April, the signal is going to be adjusted anyway, so you won't buy as much as you would have if the signal had happened right now. Yes, it can be imperfect. That's right. But so what? Good enough, close enough is good enough, and nobody can be perfect anyway. Now, all that said, I don't want to attack you for this instinct to buy when prices are down. Moreover, I'm very pleased to see that the spirit of the plans is pervading everybody's thinking. It used to be when I first started these plans that react to lower prices by buying, I would always get this reaction, shouldn't we be selling? Shouldn't we be selling? And the fear was running rampant. And I want to escape these falling prices. I don't get that anymore. The questions I get now are like the ones you asked about this. Is it time to buy now? Can I buy now? In that sense, I'm very encouraged. If your reaction to seeing prices down is, should I buy? I'm really happy with that, because that will serve you much better than becoming fearful when prices are down. So on that score, good job, guys. But no, I don't recommend buying mid-quarter. If you want to do it on your own, go for it. Just you won't have any guidance from the letter, because the letter will simply wait until the quarterly schedule, always. I won't deviate from that. Somebody has to stick with the plan, right? And I will in the letter. We're probably at a good spot now, though. So if you are buying now, don't feel guilty about it. And I do admire your instinct to buy, because that's what the letter does. Typical variation of this question goes as follows. How about a rule saying that whenever a stock fund enters 30 down territory mid-quarter, we buy? You can use any metric you want to define a buy signal, the 30 down rule, threshold, moving averages, certain sentiment levels. You still won't know. I don't care how many layers you put on this. I don't care how smart you want to make it look. You still won't know. And you won't know until we get on the other side of this. And because you can't know, why not give yourself a break by just sticking with the quarterly schedule? But I'm not emotional about this whatsoever, where I'm a non-emotional guy. Our plans run a double buy signal of time and price. My back testing shows that this is what works best. I recommend you stick with the quarterly signal, and the letter always will. Kelly in Florida, who subscribed in 2014, says, I failed to follow the signals of your 9-sig plan as I moved to Florida to start a new career, and I sunk my extra cash into my business, so I'm out of buying power. I'm heavy into TQQQ. What should I do now? Well, the good news is that yours is a simple decision tree. Just hold on for the recovery. You don't have money to take advantage of a buy signal, and you're not going to sell at this point, so just hold on. And you're also not alone. Quite a few people have not followed the plans closely, judging by emails, and the advice to everybody's the same. Just hold on. That's the only thing you have to do at this point. I would say this is an argument in favor, back to the previous question of should I take action now? No, you should just follow the plan, and Kelly, in the future, just follow the plan. But for the moment you're in right now, the position you find yourself in now, simply hold on. That's the only thing for you to do. And take heart. I mean, the letter is right now showing a clear buy zone for 9-sig, indicating we're probably going to get a pretty big buy signal at the end of the first quarter. You should take that as a strong hold signal, as a strong whatever you do, don't sell signal, which is what a lot of people had in March 2020. And the letter itself didn't have enough buying power to fully fulfill that buy signal. And that's okay. So you're in that position, and for what it's worth, I believe you're going to be just fine. We may go down a little bit more, but I think you're going to be just fine. Just take a lesson from this, that you should follow the plans more closely in the future. Hold on now, maybe stop paying attention to news for a while until we do get a recovery, since you can't do anything with it anyway. But do not sell. Mohan from Wisconsin, who subscribed in 2008, repeated a question he asked in the comments of note 9 sent February 27th, which goes, how do you think INDX and TQQQ, the INDX is the Nasdaq 100, would be affected if China took possession of Taiwan's semiconductor industry? Income Sig is heavily dependent on the Nasdaq's well-being if you leave out AGG as a diversifier. That's true. And other subscribers asked, in Income Sig, is it bad that QYLD and TQQQ are correlated? Okay, let's get to that first one. Yes, if China took over Taiwan, it would be devastating to the semiconductor industry. I believe it would be devastating. It's the biggest risk out there, as far as I'm concerned. It would be devastating to world politics, because it could bring the U.S. into conflict with China. I think there's a much higher risk of a major war in that scenario than there is from Russia's invasion of Ukraine, as bad as this current war is. So geopolitically, it would be a crisis of the highest we've seen in many years. And there's a chance if China won that war and took Taiwan by force, and those who would try to protect Taiwan, which I assume would include the United States and Japan, probably others, if that side was unable to save Taiwan, there's a chance it could change the global order for the worse. You do not want the Chinese Communist Party controlling world affairs. And if they were able to take Taiwan by force, they'd have a greater chance of doing so. So that would be a big deal. And specifically for the tech industry, it would be a big deal because Taiwan plays such a central role. With all due respect to Ukraine and even Russia, those economies aren't very big. And Russia's, the only way Russia matters is through oil, and they don't even matter that much there. It's around 10%-ish of oil, which is easily replaced. And Ukraine doesn't have a very well-developed economy yet. But when you start talking about Taiwan, wow, that's a key ally of the United States, a key partner of Japan, a key player in the tech business. Specifically, semiconductors are a big deal. If China took over Taiwan in a way that compromised all of the semiconductor IP in Taiwan, and they were taken away, that IP and the resulting products were taken away from the West and they fell into the Chinese hands, et cetera. If the worst case scenario played out, it would deal a heavy blow to the tech industry. So therefore the Nasdaq 100 and therefore our plans that use TQQQ. What to do about that? Nothing. I mean, we can't plan for every contingency, right? Because Taiwan might be vulnerable to an attack by China that Taiwan could possibly lose, and that maybe Taiwan Semiconductor wouldn't be able to guard against among other companies. There is no reason to say, well, I'm never touching that index. Because first of all, it would affect the S&P 500. It would affect all stock markets because tech is so pervasive now. So we can't run away from this risk because it's a risk. But the honest answer is yes, if China completely succeeded in overtaking everything in Taiwan and nothing was protected and moved out ahead of time, and all of the technology we have access to disappeared, it'd be terrible for the Nasdaq 100, terrible for the world, terrible for our portfolios. It would be terrible. But I just want to come out and say, so what? I mean, it feels like some of these questions come across as a gotcha. What if this happened? Wouldn't that screw the portfolios? Well, yeah, we can concoct scenarios that would be bad for the portfolios, but I don't think that's a reason to change the portfolios. Yes, bad things could happen, and that's certainly among them. As far as it being possibly bad that QYLD and TQQQ are correlated in the sense that they both use the NASDAQ 100, I'm not so worried about correlation, but I will say that I'm not convinced yet that QYLD is the best choice as the income fund for Income Sig, which is not to say that the plan is in beta or not working, or anybody who's running it now started too soon. No. Over the long period of time that I tested, the real time and then the simulated time, QYLD was the best fund to have. However, last year, XYLD, that's the S&P 500 equivalent, and RYLD, the Russell 2000 equivalent, did do better than QYLD. And so far this year, they've done better as well. Will that persist? I just don't know yet. We don't have enough data on those, and we do have plenty of encouraging data on QYLD. I'm not too worried about it falling along with TQQQ, just because that greater fluctuation that we sometimes get from QYLD can work in its favor if the other plans do well and it falls down in allocation. We end up buying more shares of QYLD. Other plans, I didn't mean other plans, I meant if the other funds in Income Sig do relatively better, such that we end up buying more shares of QYLD, which has happened a couple times in the past, then we could benefit from its greater fluctuation. Now, it's of course, the correlation problem would be that both TQQQ and QYLD go down at the same time and up at the same time, so we don't have quite that zigzag of opportunity of selling high and buying low. But in the COVID crash, for example, QYLD fell less than XYLD. So we just don't have a lot of data to go on yet. And within that limited visibility, it looked to me that the best fund to start with in that income slot was QYLD. Now, it should come as comfort that if I do decide later I'm going to change, it'd be a simple thing to do. At the quarterly signal, I would just say, well, turns out the XYLD is better, and we're gonna we're gonna sell our shares of QYLD and just swap in XYLD at this point. Or if another income fund comes along that looks better. I don't expect that, but it wouldn't be nuts to do that. And it wouldn't be such a shock if that turned out to be the case, just because we have such limited visibility. In some timeframes, QYLD was better, like the COVID crash. In the recent time frame, it hasn't been as good. In the long time frame, it's the longest one, and it has better data than the others. So it still looks like the best choice for now, but recently it hasn't been, and that's why people are really zeroing in on that. But I mean, that's true. However, I want to caution you against thinking that, oh my gosh, we're on the wrong horse here. This QYLD is a disaster. That isn't the case at all. The differences among these funds are marginal. If we were running XYLD instead of QYLD, we might be a couple percentage points different. I haven't run the numbers, but my point is that it wouldn't be an enormous difference. We're not talking about, do we use a general bond fund or a 3x leverage stock fund here? It's not that huge a difference. The distinction among those covered call ETFs, which is what all of these are that I'm talking about, is not that great. It might turn out that one of the others is going to be better for the plan later when I have more data, but I don't think so. And so far, that's not the case. But if it ever is the case, we can make that switch. And in the meantime, it's not going to be a huge differential because of going with QYLD. All right, well, that'll do it for this video. I do have many more questions, and I'm looking forward to getting to those with you. I hope this was helpful, and I will be in touch again soon. Thanks for watching.